Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is James Ng. Thanks for being on the show, James.
Thanks for having me, Whitney.
Yeah, it's a pleasure to have you on the show. And James serves as the senior director for Old Capital. I'm sure most of you have heard of Old Capital. He's actively involved in financing commercial real estate with a focus on multifamily in Texas. Has financed over $500 million in multifamily property. Currently, he's invested as a limited partner in 21 multifamily properties totaling over 6,000 units. So it's obvious you have lots of experience in the industry from different angles, James. It's a pleasure to have you on. Give the listeners a little more about your background and your focus right now.
Yeah, I was born and raised in Houston, Texas, and then I actually went to school at University of Texas in Austin. And then I made my way up here to Dallas. And so I've sort of lived in all sort of your major metros except San Antonio down here in Texas. And so I like the growth down here, the population, employment growth down here. And the past couple years, I've been intimately involved on the multifamily side in terms of financing and then also investing here in Texas. And so I appreciate you having me on.
Yeah, thank you. And so what do you do right now? What is your focus? Who are you working for and what do you do? Just so the listeners understand what your specialty is.
Yeah, so starting in 2015, I joined Old Capital, and the focus really was on originating multifamily debt. So that can be Fannie Mae, Freddie Mac, CMBS. It could be a bridge loan, a bank loan, all those different types. So essentially people come to me and say, look, James, I got, 100 units under contract. I need to figure out the financing. What's the best option for me? And I sort of hold their hand and walk them sort of step by step through the process and make sure that they close in the time frame given. And, usually that's 45 to 60 days. And I, utilize all my resources to help them find the best debt and then also really help build their team out, right? So whether they need a property management company, whether they need a general contractor, all those pieces we help sort of put together for people.
Nice. So, somebody that is not familiar with buying commercial property or large properties, you just said a bunch of names there that they're going to say, well, who are those people, right?
Right.
So, I give us, on a more basic level, tell us what that, Freddie Mae, yeah, those names, right?
Yeah,
Mac, tell us, what that is and why that's important.
Yeah, I mean, I think the easiest thing, and I think I put out a white paper on this, but essentially it comes down to three questions. Number one, when you're looking at a property, what is the occupancy of the property? And if it is 90% or above, it is considered stabilized, okay? So that's the first question I'm going to ask you, number one. Second question is going to be, what is your sponsorship group's net worth and liquidity? All right. And then number three is, do you have prior multifamily experience? And the answer to those three questions are essentially going to tell me what type of loan the property qualifies for, and then what type of loan you as an investor qualify for. And those questions, so Fannie Mae and Freddie Mac are essentially government agencies right now, and they are lending on stabilized properties. So stabilized properties, and they want you to have multifamily experience. So to qualify for a Fannie Mae loan, the property needs to be 90% occupied for the last 90 days. And then you, as the investor group, need to have a net worth greater than the loan amount. And then you also need post-close liquidity, so cash or marketable securities, non-retirement, of at least 10% of the loan amount. And if you're able to hit both of those, then you can qualify for a Fannie Mae loan. And so it's on Fannie Mae, it's essentially probably 75% on the property and 25% you as the borrower. And if it falls outside of that box, so it doesn't qualify Fannie Mae, it doesn't qualify Freddie Mac, then that's when you're going to walk into a bridge loan or a recourse bank loan. And so if your occupancy is lower or you don't have experience on your first, you're looking at doing your first deal, then it's probably a bank loan at the very beginning.
Nice. No, that's perfect. I really appreciate you just walking through that. Listeners never heard of that type of debt before, also known as agency debt. That's awesome. And so now they can kind of have an understanding of, well, can I go get that? Do I qualify, or what you're going to ask them before you even have the conversation. So you mentioned, somebody comes to you with a property, and you're going to help them figure out the financing. And so, pretty much you're going to go through those questions, right? And then, how do you help them find the best debt, or, what else is going to help us to know the best type of debt that we should use? Go ahead.
Yeah. So somebody typically, let's say a listing broker sends you a deal, and you get the offering memorandum, you get the trailing 12 financials, you get the rent roll. You analyze the deal, you say, all right, this deal makes sense on paper. You send it over to me. Essentially, I'm going to take those items and show it to 2, 3, maybe 4 lenders. And then they're going to come back and say, all right, this is the leverage that I can do. This is the interest only. These are the terms that I would be able to offer on this deal. And so we're going to shop that deal with lenders that we have a previous relationship with. And so they typically respond in 24 hours. Right. And from there, we're going to get you back to the investor the best terms possible. And so whereas you might do, a general partner in the sort of multifamily syndication game, they might do 1 or 2 deals a year, potentially, maybe more. But like we are doing probably 4 to 5 deals a month with these lenders. And so the response that we get is significantly faster, and they're going to put out the best terms possible because they know that we're not only going to bring them this deal, but potentially more deals behind it.
Wow. So, if I, let's say, I'll give you a scenario kind of, but somebody that's just getting in the business, which I know quite a few of the listeners are just trying to get into the syndication, but they're not going to have the liquidity, and they're not going to have the experience with commercial properties. Maybe they've had small multifamily, or let's talk about that. What qualifies as the experience?
Experience is essentially you signing on a Fannie Mae or Freddie Mac loan. So if you're a key principal on a deal, a loan guarantor on somebody else's deal, that's one way of qualifying. Another way is if you do, let's say, a bank loan, a recourse bank loan on a multifamily property, and you've held that property for at least a year, then that is considered multifamily experience.
Nice.
And they want it, and they also want it to be a comparable size. So if you're buying if you do a 10-unit deal, and then all of a sudden you say, all right, I'm moving up to 200 units, that's a little bit too big of a jump. They sort of want you to go up the ladder slowly, right? So they'll say, all right, maybe you go from 10 units to 40 units to 70 units to 200 units, and sort of work your way up the ladder that way.
Okay. Well, that sounds great, right? Work your way up. I've heard that forever, but let's, James, I don't want this to take forever, right? I want to get right into the big properties. I want to jump right in there. I know that's what some of the listeners are thinking. So, help me to figure out how to do that. How do I, if I find a 100-unit deal today, but let's say I've only had a few single family homes, or I flipped some homes, but now I've decided, okay, syndication is the way I want to go, and I need some agency debt. What's my options?
So you need to find a partner who will sign with you on a Fannie Mae loan. And that partner it can be more than one person, but at least one person needs that multifamily experience. And then when we add up the sponsorship group's total net worth and liquidity, that's what we're going to be looking for. And so, let's say it's a $10 million deal, $8 million loan, they're going to need all the KPs who are signing to have a total net worth of $8 million. And then after the down payment, you're still going to need $800,000 across all the key principals.
Okay. So I got to find some partners. I got to find some, so I could find, it could be many partners, right? If it was $10 million, I could have, 2 different people with $5 million of liquidity. Is that correct?
They add up. So they add up the net worth and they add up the liquidity. The net worth, essentially you fill out an Excel template and send it in, and you sign that it's authorized, that, you're basically signing away that this is correct. But the liquidity, they get actual bank statements for the last 2 months and make sure that the liquidity is there.
That's understandable.
Yeah.
And so, but then let's say those two people have no experience. They're just wealthy individuals that are wanting to be in on this deal. But
Right.
now I can bring a third person in if I needed to that just has experience, correct?
Yes. So they almost look at it as like one person, but you might have 4 people to fill in all those gaps in the sponsorship group. And then what's great is, let's say Whitney, on your first deal, you don't have multifamily experience, but you sign with somebody else, and then you're on deal number 1 and you closed in January of 2019. Now, 4 or 5 months later, you are now qualified to do the deal on your own. So now if you have the deal and you have multifamily experience, now you might need to just bring in net worth and liquidity on somebody, using someone else's balance sheet to do your next deal.
Nice. So let me clarify. So even if I don't have the liquidity or the balance sheet, I can still sign on the debt as long as somebody else
Correct.
does, right?
Yes.
Okay. And so if I already have this set up and I don't have the, for the, listeners, never done a deal before, never done a agency debt, but if they're putting this team together and they find somebody with the experience and the liquidity, now they can get the debt. They should sign on it as well. Is that what you're
They
saying?
should sign on as well. And then, because what happens is, as a general partner, the more things that you have, right? So if you have the deal, you have the net worth and liquidity, and you have the multifamily experience, really you don't need anybody else to sign with you. It can just be you. And so your percentage of the deal, whether you're doing a preferred return or you're doing, a percentage of the equity, however you're structuring the deal, you're going to get more of the deal, the more pieces of that puzzle that you bring to get to the deal, right? And
Yes.
so that's going to help you in sort of your negotiation with potential partners, right? So if someone's coming in and they have multifamily experience and they have net worth and liquidity, then they might take half the deal from you.
Nice. No, I feel like you've made so many good points already. That's really good. I mean, somebody that's getting into their first deal, they're working so hard to put this team together, and that, if nobody tells them, they may not think, well, I should be signing on this as well. Even though I don't have the balance sheet, I can still sign.
Yeah, you can still sign, get some experience, and it'll be a lot easier on your next deal.
So what's going to really set us up for success when we come to you, with that information? Should it be packaged? What should that look like? So, let's say I have those team members lined up that has experience and balance sheet. What does that need to look like when I come to you?
So typically we ask people to send over personal financial statement and potentially a resume or a schedule of real estate if they have anything currently. And so we'll review their balance sheets to make sure they qualify for the loan as a group. And then also, once you send me your T12 rent roll offering memorandum on a deal, the other 2 things that I'm going to ask you for are your year 1 pro forma. So your budget for the first year. So what do you think rents can get to when you go in? What do you think expenses can run at? And then also your rehab budget. So how much are you going to spend on the property? Is it $3,000 a door, $4,000 a door, $5,000 a door? Let's figure out what your rehab budget is. And from there, then I can get you the most accurate term sheet.
Nice. So, as far as our relationship with somebody like you, does that, if it's packaged a certain way, does it matter? If that, do we need some kind of relationship or reach out to you maybe before we have a deal?
Yes. So that usually what I do is people will reach out, we'll review their personal financial statement. We'll go through loans a little bit more in detail so that they can sort of, when they get a deal from a listing broker, they can at least at a high level gut check it and say, all right, what type of loan does this even qualify for to start? And then they can start underwriting deals. And then once they, let's say, tour the deal, they like the deal, they're going to submit an LOI next week. Then that's typically when they'll send me the information. We'll size the deal up, and then we'll have a term sheet to go with their offer. So they're gonna submit an LOI that shows, all right, this is the purchase price, this is my earnest money, all the terms of the deal. They'll have our term sheet, with the debt. And then they'll also, I like to have general partners put how they're going to raise the equity also in that package. And if they have bank statements or anything like that, that they can show that the key principals actually have the equity to close this deal, then that to me, as a seller, that's super strong, right? You're showing me that number one, you can qualify for the debt. Number two, you can raise the equity, or even if you syndicate the equity and you have a couple $100,000 left, the key principals can write a check and the deal is going to get closed.
I like it. Yeah. So, yeah, I just want to be ahead of the game, right? So if I'm presenting something, I don't want you to have to come back to me 12 times asking for more things. So I want to just be, have all that prepared as possible so we can move as fast as possible, right? So what are problems that you see come up, or maybe some ways that, somebody asked, or applied for debt and it didn't happen, and why?
I think sometimes when people are reviewing their personal financial statement, sometimes we get that late in the game. And so they don't tell us about maybe some bad credit. So with Fannie Mae and Freddie Mac, you need a credit score of at least 650 to sign on these loans. And then also, if you have any prior bankruptcy or litigation currently against you, you need to tell the lender upfront. And so when we send you the loan application, there are questions in there that ask specifically the key principles on the deal. Have you ever declared bankruptcy? Have you ever, do you have any litigation currently against you? And it's always better to be upfront about that versus the lender running the search and it coming up and then them coming back to you. So I would say that's probably number one on the borrower side. On the property side, usually as long as the occupancy and the property is stabilized, we really haven't had an issue unless the seller, sometimes the seller gets the deal under contract and they say, all right, I'm out of here. I'm going on vacation. I'll see you in 2 months. Hopefully the money shows up. And the property's occupancy goes from 90 to 85 to 80%. And all of a sudden now Fannie Mae can't lend on the property. So that has been an issue for us on some deals. And then also I would say make sure that you have an environmental report done. So the typical report is called a phase 1 environmental, and that tells you sort of historical use of the property and then also the surrounding areas, whether it's a gas station or dry cleaner, you really don't want any of that coming through your property in terms of chemicals, and you actually have to look at the groundwater and see which way it's flowing. And then the last thing I would say that has surprised some investors is floodplains. And so flood insurance has gotten expensive, especially down in Houston because of all these hurricanes coming off the coast. Understanding if your property is in a floodplain, how does that impact your insurance requirements? Because Fannie and Freddie will have insurance. Sorry about that. If Fannie and Freddie will have insurance requirements if it's in a floodplain, where it could be double or triple the cost of your standard insurance policy.
Are there a limit to the amount of agency loans that we can have?
So agency loans are non-recourse. And so what that means is they cannot go after you personally for the difference if they ended up foreclosing on the deal. And so you can essentially have as many non-recourse loans as you want. And so there are carve-outs where that essentially if the general partner commits fraud, they don't, apply. Let's say you have a fire on the property and you don't apply insurance proceeds to the property, you just keep the money. If you don't do your financial reporting. So there's a list of like 10 or 15 things that are in the loan agreement that essentially say, as long as you do everything that you say you're going to do, then this loan is non-recourse. But in the industry, we like to call these bad boy carve-outs. If you're a bad boy, the loan can turn recourse. And so just be careful with that.
Are you a new or sophisticated investor wanting to learn how to operate a successful syndication business? For life-changing training from the nation's leading syndication expert, my friend Vinny Chopra has the training you need. Text LEARN, LEARN, to 474747. So, we mentioned a couple different types of debt, and I was thinking about, agency debt versus, like a local lender, a credit union, something like that. Why,
Yes.
Why would somebody use one of those over agency debt or vice versa?
Sure. So on Fannie and Freddie, the typical terms that we're doing are 10-year loans. It has 30-year amortization, and it usually has it can have 3 years of interest only up to 5 years interest only. And their leverage is close to 75 to 80%. And so those are the best terms that you're going to get anywhere. And it's all non-recourse. And so if a deal qualifies Fannie and Freddie, it almost always wins. The biggest negative to agency loans are they have the largest prepayment penalty. And so Fannie Mae loans have a thing called yield maintenance. And what that essentially means is you are paying the interest payments for the remaining term all today. And they take the present value of all those payments. Let's say you get a 10-year loan, and a lot of people have like a 5-year hold. Well, the next 5 years, you still have to make those payments, but they're taking the present value of those payments. So it can be a rather high prepayment penalty. And so that's on the Fannie Freddie side. On the recourse bank loan, their leverage is typically 75% max. They usually are doing 1 year of interest only. And then the amortization is anywhere from 20 to 25 years. And so that materially impacts your cash flow. And you just can't, most people, the only reason that they're doing a recourse bank loan is it is not qualifying for Fannie or Freddie, or the loan is under $1 million. And so Fannie and Freddie, I think the lowest Fannie loan that I've seen is like $750,000. Nobody wants to go through all the paperwork to do a $750,000 Fannie Mae loan. And most likely, if you're buying a property that only needs like $1 million loan, you probably are not going to hold that property for that long, right? So most of the time you're going to buy it, fix the problem, rehab it, and then sell it on 1 or 2 years. And you just don't want yield maintenance on that. You're going to want banks can give you what's called a step down prepayment. So it might be a 3-2-1. So that's a percentage of the loan. Whereas yield maintenance would be, it could be 20% of the loan amount for the first couple of years. And so most people doing smaller deals or non-stabilized deals will use recourse loans. And then people who have buying stabilized deals, larger deals, they'll do the non-recourse Fannie Freddie.
So I was thinking about that prepayment penalty, and a big negative, right? I mean, if you have to pay that fee. However, right. So I was thinking about a lot of people will purchase just like a lot of guys do now. They're planning on holding for 5 years, but they may have a 10-year debt, and so. Right. A big selling point is, you have this loan that's low interest. Well, 5 years from now, the interest rates are probably going to be higher, right? And so you hope, obviously you hope that they'll assume that note, but that would keep you from paying that penalty, right?
Yes. So the tricky thing about assumptions is, let's go back to that example of you bought a $10 million deal, mm-hmm. and you got an $8 million loan. And now, you've done a fantastic job on the deal. And now it's worth, let's just be optimistic, $16 million. And the loan is $8 million still. And the person who's buying your deal, if they assume your loan at $8 million, the leverage is only 50%, right? So $8 million divided by your 16. And most people, that doesn't work for them. And so given that the interest rate is lower, that might be great, but they probably want an 75 to 80% loan on the deal. So they probably want a $12 million loan. And so Fannie Mae actually has a program for this, and it's called a supplemental loan. And so Fannie Mae can do a supplemental loan when someone else is buying your property. They can re-leverage it to 75%. So you can keep the $8 million loan in place and then add a $4 million supplemental. And the thing that you have to watch out for is they really, with 5 years left or less, they don't do supplementals anymore. So you have to be very careful that you have, let's say you go to list the property, you want to make sure that, when you go to list, there's at least 6 years left to maturity if you think anyone's going to assume this deal. And there are certain rules so the cutoffs you have to be careful of: 7 years left to maturity and 5 years left to maturity. Those two cutoffs change what the supplemental can be. And so you have to watch those timelines if you think you're going to sell on an assumption.
Excellent. No, I appreciate you elaborating on the assumptions. That's great. I'm sure, I'm sure a lot of people have never heard that before, in parts that I haven't heard. So what's been the hardest part, just going into the last few questions before we run out of time, what's been the hardest part of the syndication business for you? I know you've been on the lending side and the passive investor side, but what's been the hardest part for you?
The hardest part, so I talked to a lot of general partners, and the hardest part is there's two things that a general partner has to do, right? They have to find deals, and then they have to raise equity. And finding deals right now, so we're sort of first quarter 2019, the finding deals part is actually not as competitive right now. And so in fourth quarter of 2018, interest rates ran up significantly. So 10-year money was, 10-year debt was at 5.25. That has significantly reversed. And so right now we're closing loans. The loan can be anywhere from about 4.5% interest rate. And so that has shifted dramatically. So your leverage has improved, the cash flow is there. So there's actually less competition for deals, and interest rates are still low. And so I would say the number one thing right now is the ability to raise equity and getting people comfortable with the returns. So a lot of people in Dallas, like when I started in 2015, everybody thought that was the top of the market, 2015. So I could have been sitting here for 4 years not investing in any deal because I thought it was the top, right? And the people who bought deals in like 2011, 2012, they were just completely spoiled by their returns. So they might have made a double, like 2x, 3x on their equity in 3 to 4 years. And so you're having to go back to those investors right now and tell them, look, we're not going to double your money. We're going to get like a 70% return. You give me 100, I'm going to give you 170,000 over the next 5 years. And so some of the equity is saying, well, I'm going to stay on the sidelines then. That's just too low of a return for me. And so investors are having like some of their guys that they counted on in 2014 or 2015 for equity, those people aren't there anymore. And so you're having to constantly meet new people, educate them on sort of the benefits of multifamily, and then convince them that this is the best time to be investing in multifamily. And so to me, it's that ability to raise equity, and the investors who have been able to do that have been able to, do the best in terms of buying deals because they're confident in their ability to raise the equity, and the debt markets right now have been very forgiving, and that the interest rates have come down, and you're locking in 10-year money at 4.5%.
Awesome. Yeah, we were just looking at a deal, and I think we're go agency debt as well. I was very surprised at the interest, but you mentioned getting investors comfortable with the returns. Do you have any advice on how to do that, or what that should look like?
There's a couple ways. Always start with your track record. And like I did a podcast on this about a month ago, and Warren Buffett put out his latest letter to his shareholders. And on the very first page, it shows the S&P 500 versus Berkshire Hathaway over the last 50 years. And Berkshire Hathaway's annual return was 20%. S&P's was 8 or 9%. And so very first page, he doesn't even have any text on the first page. All it says is, here's my column of results. Here's the S&P 500. And so to me as an investor, as a passive, the first thing that I'm looking for is what's the track record? What's the track record of the general partner? Have they done this before? Have they, syndicated a deal? Like if I go drive by their properties right now, how does it look? Right? Is this something that I want to invest in? And if you don't have that, you need to go borrow that and get that from somebody else. Right? So number one is the track record. And then second, I would say is how much of the return, so that 70% return that we were talking about over 5 years, how much of the return is coming from cash flow and how much of the return is coming from your residual sale? And so a lot of times you'll see, a 5-year cash flow and, you put in 100,000, first year might be 5%, then 7%, then 8%. And so at least half of the return maybe will come from cash flow and half will come from residual sale. On a bridge deal where they're doing 10,000 or 20,000 a door in rehab and kicking every tenant out, it's like 100,000 goes in, 0, 0, 0, and then 200,000 at the end. And so that might be a higher return. It might be a 2x on your equity multiple, but there's significantly more risk in that deal when you're comparing them. So as an LP, I think it's good to have at least the cash flow taken care of for your first couple of deals. And then as you get a little bit more adventurous on your sort of heavy value add deals, then you can do a couple of those. So I'm in like 2 of those deals where the cash flow is 0 for the first 18 months or so. And then they're hoping to refinance or sell the asset and get a large return on those deals. And so the only reason I got comfortable with those deals was because of the track record of those general partners.
I appreciate you sharing that. And what's the one thing that's contributed to your success?
I think the one thing is the ability to put together skills. So I started in finance, then I moved to underwriting. Now I'm more on the origination side of financing transactions. And so each one of the roles that I had, whether it was corporate finance, whether it was underwriting, whether it was loan origination and investing, the skill sets have built upon each other. And each one of those made me a better investor. And so that's how I like to look at projects and things that I do is sort of, is this building new skills, new relationships? And that's how I determine how to take on projects. And I think that is, especially right now, like our ability to do this interview, understanding the technology piece, I think a lot of people in real estate do not utilize the technology that's available. And we have used that at our firm to grow our brand, and my personal brand is the technology piece that a lot of people should be using in the industry.
And how do you like to give back?
So we just actually, I should tag you on our Facebook post, but we just did a 3-on-3 basketball tournament for a nonprofit called City House. And they actually help kids 0 to 17 who essentially come from either abused homes or foster homes, and essentially give them a place to live and grow up and go to school and just be normal kids. And so we raised about $12,500 for that group. And we made it part of the industry. So we had listing brokers there, property managers there, general partners, and we were just playing good old 3-on-3 basketball and raised money for that group, because I think a lot of people in the industry want to get back, but they don't know what the organizations that they should be working with. And so we interviewed 4 or 5 organizations, and this group really rose to the top. And so they had a shelter. It's called My Friend's Place, and it's about 10 years old. And so the money that we raised is essentially going to rehab that whole facility that's about 10,000 square feet and do sort of new flooring, paint, carpet, like all the stuff we do with apartments, but we're doing it on their shelter that they have here in Dallas.
Wow. Thanks for sharing that. Thanks for being a part of that and contributing. That's amazing. So James, you've provided so much value to the listeners and to myself. I can't thank you enough for being on the show. Tell the listeners how they can learn more about you and get in touch with you.
Couple ways. I mean, our company's podcast is Old Capital Podcast,
which I highly recommend.
Yeah. So that is a huge, we do at least one a week on there, interviewing general partners, property managers, listing brokers, everybody sort of in the market. Definitely, if you want to reach out to me, my email is jeng@oldcapitallending.com. And then if you just search my name, you'll find my LinkedIn, YouTube videos, all that type of stuff. And I think that'll be the best place to reach out to me.
Awesome. Thank you so much, James. And I appreciate the listeners, being with us today and every day. I hope you'll also go to LifeBridge Capital and connect with me, and then go to the Facebook group, the Real Estate Syndication Show, so we can all learn from experts like James and ask questions and grow our businesses together. I hope you'll do me a favor and share the show, and we will talk to each of you tomorrow.
All right. Great. Thanks a lot, Whitney.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.